Hello, this is Tom from InOutSignal with a recording on Sunday, June 3rd, 2012. I would like to march you through a few slides on my computer showing you why I think that on Friday, June 1st, 2012, the market really went sour, and as such, the in-out signal, traffic light signal, went red. Let us start with a little look onto Elliott waves. Here we have the Dow in a daily chart, and we can see a pattern that we thought would be a 5-wave pattern, a dynamic move up here in October, then a move down to December 2011, and then a nice upward move, wave 3, to April, May. Now we have had this correction that we were expecting to go about 38%, but as we can see, it moved much further than that. And on Friday, the last candle, the long candle, you can see here, actually penetrated this 5th wave defense line, and this is the important line that cannot be penetrated according to the Elliott theory if we want to get a 5-wave pattern. So the 5th wave would have been expected to go up here, but after that break of this defense line, this pattern cannot be counted anymore as such. So in a way, this has eliminated the idea that we would have a dynamic 5-wave upwards pattern. Now let's look at the other US indices. For example, the S&P, we can see a similar pattern also. 1, 2, the 3 would have been here, the 4 would have been here. Again, the last motion here, but also already this motion going down within May below this pink line showed us that most likely this pattern will not be possible. So the S&P has another possibility. You can see a second defense line here, which has not been penetrated on Friday, but because of all the indices moving south, it's very likely that this line would also be penetrated, and that would also eliminate the idea of this being a 5-wave pattern, a dynamic 5-wave pattern. Let's have a look at the German DAX index, and again we have a little bit of a different setup here. We have a smaller wave, 1, 2, 3. The 4th wave would have been possible still down to this pink line, and this pink line has been dynamically penetrated on Friday, and we are now on the other side with a weak ending on the other side. So this is definitely a pattern that we would not allow anymore in terms of Elliott waves. So these are the Elliott wave considerations, and there are others that are posted on the InOutSignals. You know that on InOutSignals I'm monitoring a number of signals from people that have a long time record of generating highly reliable long-term signals. And as you see here in these two red lines, the decision moves page has already turned red a while ago. Here on the 2nd of March, decision moves switched to from the SPY, which is the S&P500, to long bonds. Then the ETF bully, it's another person that I'm monitoring on a weekly base. Uli has a very good weekly stat sheet where he gives two charts always showing indicators. Here you can see the domestic equity mutual fund indicator, and you will find that this one has not triggered a sell signal, but it's getting close to this red line, whereas this international equity indicator has already triggered a buy signal a while ago. It's listed here on the 17th of May. So we have two signals. In addition, I'm also monitoring Ralph Gerke's international indicator, and this indicator shows on his chart that it has crossed already the threshold line of 1, but for him to generate a sell signal, this is an international indicator, so it would be for the global markets. Also, the moving average is a 36 or 38 moving average would have to penetrate the threshold line, and expected that this will happen tomorrow. So to summarize, two signals have already turned red. A third one is likely to show up tomorrow on Monday, June 4th. And the Elliott wave analysis has shown that this strong move on Friday is definitely giving a very bearish sense to the current market situation. So recommendation here is be careful with investments and do not put money at risk. Thank you, and see you soon again here on InOutSignal.